we're gonna get to mortgages. And I am a portfolio manager, I was a tax lawyer, I love speaking and guest lecturing, and I'm a mother of 3, but what I'm not is a mortgage specialist. That said, I do often act as a financial sounding board or quarterback for clients for their financial needs, and so I'm knowledgeable on it. And as a treat, after I discuss it, I'm gonna record a conversation with someone who works in mortgages, and we can explore it from different angles. So just to introduce the idea, I'm gonna cover some of the key kind of concepts and terms we use when we talk about mortgages. So what is a mortgage? A mortgage is a loan on a property or home. And what makes a mortgage different than another loan is that the property is used as collateral. So if someone defaults on their loan, the bank can take the property. One of the key concepts that we cover when we talk about mortgages is interest rates. And on a mortgage, your interest rate can be variable or fixed. Let's talk about fixed first because it's a bit simpler. On a fixed mortgage, on a fixed interest rate, you just pick your term and your interest rate, and you know you'll be paying that interest rate for the term. So if it's 5 years at 5%, you can predict that, and then after that, you renew it with the bank. If it's variable, then your interest rate will vary with government interest rates. And so for people who have a variable interest rate, their interest payments have gone up a ton since this year. And unfortunately, variable rates were largely a lot less expensive over the last few years, so lots of people chose them. Now, when you have a variable rate, you could still have fixed payments. So you can still rely on paying the bank the same amount every month, but what varies or what changes is the proportion of that payment that goes to interest or principal. Remember mortgage trigger rates, which I will get to in another video. Now, in addition to that, we have something when we talk about mortgages called an amortization rate. And an amortization term is how long it should take to pay the mortgage out in full. Now, this could be 25, it could be 30 years typically, and it is not the same as the term of the interest rate in Canada. It's very interesting to note that in the US, you could actually have an interest rate term that is the length of your amortization period. And that is really meaningful to people now who bought their properties at a time when interest rates were lower because they are not worried about the fact that interest rates have gone up so much. That said, in Canada, many home buyers have to be worried because they have to renew their term or they have a variable term. Now, there's a whole bunch of other concepts with respect to mortgages, like mortgage insurance in some cases. There's home buyer's plan, which incentivize you or make it more affordable to buy a home by allowing you to transfer a portion from your RSP. But I'm not going to get into the details. Unless you specifically would like me to, please send me the questions and I will. I just wanted to introduce the topic, and in the next video, I will explain mortgage trigger rates, which have become very apropos, very relevant because of the situation we're in right now. Thank you.